Welcome to the Capital News. I am your host, Alex Kreitis. Today is March 26, 2019. Thank you so much for joining me. I hope everyone is doing well out there. So what happened today in the markets? Well, the S&P was up 20 points. The Dow closed up 141. The NASDAQ closed up 54 points. And the Russell 2000, the small cap index, was up $15.30, or a gain of 1%. All of the markets, folks, they were well off of their highs for the day. But at the end of the day, as normal, something to keep an eye on, during that last hour of trading, we saw a big ramp up and they recovered from some of their daily lows. No surprise, that has to do with, I think, a lot with the computer and algorithmic trading that takes place. Certain levels are hit and it just goes one way, which typically what we have been seeing, at least for the last few months in this V-shaped recovery, it's up. At the end of the day, it trades up. And I don't know if it's just me, but take a look at some of these markets around 1:30, 2 p.m. Eastern Time in the United States. Take a look, because these markets, that seems to be where they find their bottom. 1:30, 2 p.m. And from there, it either stays there or that's the bottoming process and it tries to rally at the end of the day. It's just interesting to see how the markets behave, how they sort of breathe in and out throughout the day. But that seems to be the bottom for the day. It's just an interesting observation I've made. I don't know if that will continue, if that's significant to anything, but that's akin to, like I just said, at the last hour of trading or the last 30 minutes of trading, there tends to be a rally or at least some sort of comeback. But depending on the headline news of the day, obviously makes the determination as to what ultimately happens, whether the markets close up or down. But we remain in the world of financial Oz. So your guess is as good as the next guy's. Oil, gold, and silver was little changed for the day. 10-year Treasury was down a little bit further, and now it sits at 2.41%. 2.41%. So we have to continue to keep our eye on that, especially with the recent inversion of the yield curve between the 10 and 3 month. The VIX was down 10 percentage points today and now sits at 14.68. The Nikkei at the time of this podcast, Japanese markets are down 130 points after staging a rally yesterday. Hang Seng markets are up 145, so the Hong Kong markets and the Nikkei are opposing each other a little bit. But what was some of the news today that catapulted markets up? Well, it has to do with some of the data in the housing markets, and housing sales increased a little better than expected. However, that was in the midst of a whole bunch of other housing data that came out. So again, sort of clinging to hope, and you'll see what I mean here in a second. So we have U.S. housing starts tumble. Housing starts in the U.S. fell 8.7% month over month to an annual rate of 1,162,000 units in February, while markets expected 1,213. So we got 1,162,000. The market was expecting 1,213. Okay? It is the biggest monthly decline in 8 months, as construction of single-family homes dropped to more than a year and a half low. Meanwhile, building permits fell 1.6% to an annual rate of 1,296,000 compared to forecast of 1,300. All right. So the markets are clinging to hope. We have a few data points that come out in housing. Most of them lead to where we have been discussing, a slowdown. But you had one that beat expectations, that was slightly positive, and that's what the markets cling to. The markets are basing their strategy off of hope. I know I'm starting to sound like a broken record, but I have to drill it into your guys' heads, because if you listen to this show, you only got me for 30 minutes. But Bloomberg, CNBC, Fox Business, they got you 24/7. And they are just going to tell you, oh, nothing, it's different this time. You don't have to worry about the yield curve. You don't have to worry about 7 million Americans late on their auto payments. You don't have to worry about the millions and millions of people behind on their credit card payments. You don't have to pay attention to $1.5 trillion in debt that students have. Pay no attention to that stuff. Everybody's fine. Everything's fine. Don't pay attention to these housing numbers. Don't pay attention to all of the other indicators that are saying, well, we might have to hit the brake here. We got to slow down, or it is slowing down. Pay no attention to that stuff. Just keep buying. Just buy, and don't worry about it. That's not how it works. That's not how it works. They make their living, the mainstream media, the financial press, off of advertisers. Well, what do those advertisers want you to do? They want you to go out and spend money on their products. And when you're talking about the financial news media, you're talking about a lot of funds, mutual funds, brokerage houses. Give them your money. That's what they want. They want you to think everything is fine. That's the same thing that politicians tell you. That's the same thing that central bankers tell you. Again, you had the Three Stooges out on 60 Minutes a few weeks ago saying everything's fine. And then they said last Wednesday, oh no, we're going to cut our we're going to cut we have to cut our GDP forecasts because everything's fine. If everything was fine, why are you cutting your GDP forecast? Silence. I mean, does anybody ask them that question? No, of course not. Of course not. They're thrown softball questions, and that's all there is to it. It's a game. It's a charade. Go to sleep. That's what they want you to do. They want you to go to sleep. Do not pay attention to them. And don't ask serious questions either. Don't ask serious questions because they don't have serious answers. Now, some other news coming out of China. China industrial profits tumble 14% year over year in the January to February period. They combine the January and February period because of the Lunar New Year. But nevertheless, Chinese industrial profits tumble 14% year over year. Not good news. Not good news. Again, further indication of a global economic slowdown. We'll see how the markets respond. But at least right now, you got the Nikkei down 130, and you got the Hang Seng up 145. So there's some mixed messages going on right there. You also have out of New Zealand, their central bank holds interest rates at 1.75%. That's like their federal funds rate, which we have here in the United States. They are holding their interest rate at 1.75%, with comments saying that the next move is likely to be an interest rate cut. Not a hike, a cut. Well, we're not surprised. We're not surprised. These central bankers are going to put the pedal to the metal. That's what they do. This is going to be another race to the bottom in regards to these countries and their currencies. This is what they do. This is sickening. They think this is the only medicine that exists. They think that this is the only tool that they can implement because nobody wants to be responsible. Nobody wants to be the man or woman in charge when all of this goes kaput, when all of this goes boom. Nobody wants to be around saying, well, because then the questions are going to be, well, how didn't you see this? How didn't you know this was going to take place? And nobody wants to answer that question because nobody wants to be an adult. None of these central bankers, none of these prime ministers, none of these presidents, nobody wants to be responsible for this. Nobody. Because they just want to continue to congratulate themselves, pat themselves on the back, that they, quote-unquote, saved the system 10 years ago, and we've been on a bull market run for the past 10 years. It's a BS market run. That's what it's been. Not a bull, BS. You got to add another word on there. I'm not going to do it on this program, but you know what it is. That's the type of bull market this has been, and people are going to be in for a rude awakening. Can this market continue to live in fantasy land? Yes, it can. Yes, it can. It has for the past 10 years. It most definitely continue on for another few months, maybe even another year or two. We're in a political cycle too, which is another scary thing because you already have a president, President Trump, who is taking responsibility for the stock market, which is one of the dumbest things anybody in this world could ever do. But he did it. He did it because he can't help himself. I just think it's his ego and vanity in this regard. He has to take credit for it. Never should have done it. Boxed himself into a corner, and now he's trying to do a dance because he's going to blame somebody else when this thing comes down. It's all to his doing if it goes up. If it goes down, it's somebody else's fault. He will have a lot of his supporters agree with that sentiment, and I believe he will get a lot of people in the middle, too, because if he starts now, and we already hinted that there is some evidence that he is already starting to pivot and starting to point the finger back at the Federal Reserve He's continuing that battle and then blaming the Democrats with their endless partisan investigations into this president, into his personal life, into his business life, into his political career. Every avenue they can go down, they are going down. And he's just going to say, look, the markets love Trump. We've hit records after record. I told you, you keep coming after me, the markets aren't going to like it. So he is definitely going to point the fingers. He is going to play the blame game. So just prepare yourself for it. But this thing can continue because this is the world we live in. Yes, we have an inverted yield curve. That doesn't mean that there is a recession tomorrow. A recession will come because they have not been outlawed. This will not defy the laws of economics. But we may have another run-up in the stock market. We may continue to have positive GDP growth for the next few quarters, maybe even through the remainder of 2019. But I'm not going to be surprised if there is a big market correction. I am not going to be surprised if GDP is a lot lower than even what the Federal Reserve now thinks it's going to be for 2019, which I believe at this point they think it's going to be 2.1% for the year, which is a full 1 point below where it was for 2018, because 2018 was 3.1%. The Federal Reserve is now projecting 2019 GDP to be 2.1%. So, regardless, it's in a downshift. We know this. We know what this means for a whole host of issues that are just going to be self-fulfilling, whether it's the corporate debt, the commercial loans, the leveraged loans, the layoffs that will be coming, a whole host of things. 14% decline in profits in Chinese industrial firms. Housing starts tumbling. Who cares? Let's just keep going up because they're printing funny money. Now get this. Stephen Moore, he was a former economics reporter for the Wall Street Journal, and I think he considers himself an economist. He's buddy-buddy with Donald Trump, and the president just appointed him to be a board member on the Federal Reserve. I imagine he will get confirmed and will be sitting on the board. But here's what he said. Again, this is Stephen Moore. The Fed should cut rates 50 basis points immediately. 50 basis points immediately. We're sitting at around 2.25%, on the federal funds rate. So he's talking about, let's take this down to 1.75% to 2%. Immediately. He continues, it was wrong to do rate hikes in September and December. And then he adds, he is not a dove and not a Trump sycophant. He might be a Trump psychopath. Why do you want to cut rates? And then he claims he's not a dove. Does he not know that that's what dovish means? That he wants lower interest rates? That's what that means. He's not a Trump sycophant. That's exactly what Trump wants. He wants lower interest rates. At least that's what he says publicly. He was blaming the Federal Reserve at the end of last year and continues to blame them now. He was just blaming them last week, saying we would have 4% GDP growth if it wasn't for those idiots at the Federal Reserve. I agree that they're idiots at the Federal Reserve. That's me saying that. But of course, I think that's what Trump's saying and thinking. But nevertheless, low interest rates is what causes this bubble. Why do you want this bubble to get even bigger? Because the bigger it gets, all it's going to do is make the pain that much worse for everybody. Everybody. I mean, the president is a real estate guy. Real estate guys love low interest rates. Is that what's going on here? I mean, is he trying to get low interest rates for personal reasons, for his company? I mean, it sort of gives the impression of it. He is a real estate guy. Those buildings, those skyscrapers aren't cheap. Takes a lot of money, takes a lot of banks to do that. And you want lower interest rates. Is that what he's doing here? I hope not. But that's the way it goes. Remember his CPAC speech. He was calling for a lower, weaker dollar. Well, lowering the interest rates, that'll probably do it, at least for the short term. Because you have to remember, if the Federal Reserve does this and lowers interest rates by 50 basis points immediately, that's going to send a signal that things aren't great. So now you have the question, how does the market react? Not talking about the knee-jerk reaction, but more of the longer-term reaction to what happens to such a rate cut, 50 basis point cut? What would they do? Knee-jerk reaction, they might rally. Stocks might rally strongly, but then after the markets digest the news, well, what does that mean? We have the president out here saying everything's great. We have low unemployment. We have quote-unquote stable prices. At least that's what the government and the Federal Reserve tells us. You know that's not the case, but that's what we're told. And we know that that is the charter of the Federal Reserve. Low unemployment, stable prices. Check, check. President out there saying this is the best economy ever. So why would you have to cut interest rates? Why would you have to do it? Isn't this economy strong enough to deal with interest rates that are 2.5%? I mean, if we can't deal with 2.5%, then what can we stand? How can this be a strong economy? And don't forget, we just had the data come out that February was the largest budget deficit in history. I mean, you can't make this stuff up. So what do they want to do? They want to cut these rates so they can start with quantitative easing 4? Let's just stop that. Let's stop that normalization process with the Fed's balance sheet. Let's just put that all to an end and let's just start printing more money because we're running up record deficits. We have record national debt. I mean, hell, let's just forget it. Let's just print another $5 trillion. Let's just send these stock markets to the moon. I mean, if we can print what we've printed and everything's fine, according to these people, then why can't we print more and everything will be even better? I mean, that's sort of the logical question you have to ask, but that nobody asks it. And if you ask these people, I don't think they'd answer you. They would dance around it. That's so I'm sort of beside myself because I just came across this shortly before I got on this podcast with what Stephen Moore said. I mean, I'm not really surprised by this, but it's just disheartening because we're supposed to have a president who is draining the swamp. If you have the Federal Reserve cut interest rates, that's exactly who it helps. It helps the swamp. It helps an out-of-control government with a spending problem that is afraid to cut spending anywhere. We had tax cuts in late 2017 that gave a stimulative effect through 2018 and will have a smaller effect to the upside this year. After this year, it's basically any stimulative effect that it has is going to be gone. Now, I'm all for tax cuts, but you don't really do it at the end of a business cycle. You don't do it unless you cut spending too. But we didn't cut spending. So we have bigger deficits. We have a larger debt. That's how this all connects. I talk about this all the time, and I will continue to talk about it all the time because there's more and more people getting onto this program, and that's what this is about. It is reaching as many people as possible. It's educating as many people as possible. And so people have the tools at their disposal to act accordingly, invest accordingly, get into cash accordingly, invest in bonds accordingly, get into gold and silver. Do what you want to do, but at least you have the information. It's not lopsided. This is not the mainstream financial media that just tells you to buy, and buy. Don't look at anything. Don't forget about the data. Forget about the yield curve. Everything's fine. And just buy. Just buy. I'm not going to give you that type of information. If I thought everything was a buy, I would tell you to buy. We're not there yet. Not even close. Not even close. It's just the risk reward to me at this juncture is not worth being that aggressive in this stock market. I just don't believe it. I just don't, because I'm not going to listen to these people. I'm not going to listen to the likes of Stephen Moore say, we got to cut 50 basis points immediately. I mean, we've had it before, where we know that this was the biggest wealth transfer ever. Money going from the lower middle class to the rich. That's where it goes when you do these types of when you do this type of policy. How that's draining the swamp is beyond me. It really is. So I'm disgusted with this. I mean, again, Stephen Moore is not the end-all be-all. There are multiple voices within the Federal Reserve, although we know the general direction in which they want to move, and that is to a wait-and-see, to a more dovish stance. Well, now you have another voice in there that's saying the same thing and who's going to be advising in the same direction. Not to mention, if this does turn out to happen and we get a weaker dollar, that is going to adversely affect lower income individuals, middle class families. That's what it does. So I don't know how that's going to help those people. And I don't know how that's going to play well for the president who was going to be in a battle in 2020. Now, again, I think the president's going to win simply because of the lunatics that he's up against. And I still think that there are enough Americans in this country who are not going to allow socialism to take full control, because that's basically what we have now. That's what's on the agenda. We've been tiptoeing through the tulips here with this fascism, corporatism, with a big dose of socialism and a whole bunch of programs, Social Security, Medicare, Medicaid, all of these welfare programs, transfer payments, all this stuff. Now it's just full bore. Especially if you get somebody like Crazy Bernie in there, Spartacus, Pocahontas. You get one of them three nuts in there, that's what you're going to get. Or at least you're going to get a big push for it. Now, again, you still have the Congress and the Supreme Court who can slow them down. But when you're the president of the United States, at least in that initial year, you have some political capital. So something would get done. So let's pray to God that does not happen, because it'll be the end of this country. I already think we're pretty much at the point of no return. And given a $4.75 trillion budget that was just unveiled with $1 trillion deficits for the eye to see, where's this going to end? It is not going to be pretty. And I just think from a moral and ethical standpoint, it is such a shame, because this has been stealing so much future wealth from young people who exist today and from future generations who don't even exist today. When new babies are born, they already have tens of thousands of dollars in debt that they owe to Uncle Sam through no doing of their own. How anybody can say that is moral or ethical is beyond me. And then you got these lunatic nuts on the left who just want to up it. They have no concept of money, no concept of debt, no concept of time. I mean, you have $1.5 trillion in student debt loans. You have young people who cannot find good paying jobs. You have young people who cannot go on to let's just call it the natural process of life. They cannot afford to get married. They cannot afford to buy a home. They cannot afford to start families. This is going to have negative repercussions for this country for generations. Not to mention the other demographic problems that we are facing head on that nobody wants to talk about, that all ties into all of this other stuff. Social Security, Medicare, Medicaid, government pensions. We have more and more people who are reaching retirement age. The baby boomers. Every day, tens of thousands are retiring, or at least hitting 65, and they're eligible for retirement and to receive Social Security. Nobody's even talking about what this is going to do to the job market displacement, to the national deficits, to the national debt. Nobody's even having a conversation about it. We can talk about all this stuff and trying to have good conversation and saying, well, things aren't looking good for a whole host of reasons. But even if we somehow get through this over the next few years, we're not, but let's just say for the sake of argument, we do, and everything's fine. Let's just take the other side of it for the sake of argument, and everything's fine. It ain't going to be fine 5 years from now for sure. 10 years for sure, because of the demographics. And again, it ain't only in this country, in the United States of America. It is worldwide, especially in regards to developed countries. It's not a pretty demographic picture in Japan. It's not a pretty demographic picture in China, in Russia, in the UK, in Italy, in Greece, in Germany. Most of the developed world, it is not a pretty picture, demographically speaking. Ironically, one of the best things that we have here in the United States, despite all of the drama that it causes, is immigration. We allow people into this country. That is ultimately a good thing. We just have to tidy it up and get things squared away, that it's legally, not illegal immigration, that we have a true process, that we have people who are here on merit, not just because they jumped the fence. I think we'll be getting there. But that's what's saving the United States of America, ironically, as opposed to the rest of the world, and especially those countries that I just rattled off. So, sake of argument, everything's fine, but in 5, 10 years, it's not going to be simply because of the demographics. But I think all of that does is just simply compounds the problem, because you're going to have a whole host of people who cannot afford to retire. So what does that mean? What are they going to do? Are companies going to keep them on? I mean, all else equal, if you have somebody who's 65 years old versus somebody right out of college, the 65-year-old's probably getting paid a lot more money. And if you're in such a quagmire, economically speaking, now you got to try to save profit margins. What are you going to do? Well, Jim's been with you for 40 years, but you got to pay him a lot of money because he's experienced. Johnny here, he's just out of college. Who do you think these companies are going to get rid of? See you, Jim. Nice knowing you. See what this is going to cause? This is going to cause a ripple effect that nobody is talking about, nobody is prepared for, and it will be a downward spiral. And it's not just going to be in the United States of America. It is going to be in many of those developed countries that I just stated. It's not a pretty picture. This is not the type of puzzle that I want to put together. But it's not up to me to create these pieces. This is what we all do collectively, as individuals, as countries, as governments, as corporations. I'm simply looking at the data in front of me, piecing this puzzle together, and that, unfortunately, is the picture that I see. Can we fix it? In the long term, we can fix it, but this is a runaway train, and it's not going to be stopped. You know, we wrote about this in the Cynic's Guide to Investing, our book, self-published. Check it out. We told you in that book that the market will correct this. We said it's up to the politicians, it's up to the people of this country to solve these problems that we see, that we have been facing for a long time, that have been staring us in the face for a long time. But everybody just wants to continue to kick the can down the road. We knew that nobody would step up to the plate. And because we knew that, we said the market will correct this. The market will not be as nice as you and I could have been, and even some politicians could have been, in having a conversation and trying to create a smooth transition to some type of normalcy. Because all we're told day in and day out, if you listen to financial media, is that the U.S. consumer is healthy and strong. What a bunch of bull. Thank you so much for joining me today, ladies and gentlemen. It has been a pleasure having you. As always, please like, share, subscribe, get the word out. Continue to find pieces of this economic puzzle. Continue to put it together. Continue to think. Continue to ask questions. Get involved politically. Do what you have to do. Wake people up. Get them in tune with this program. Get them in tune with other programs like this one. Don't simply listen to the financial mainstream media who is constantly selling you the same thing. This is the Capital News. I am Alex Kreitis. Godspeed.